call it since Liberation Day, since Liberation Month, however you want to look at it, since we got tariffs announced, there's been really no question that inflation has reaccelerated.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
All right, welcome back to another edition of the Daily Dots here on September the 11th, 2025, coming to you Thursday. And of course, because it's September 11th, important day of remembrance for anyone that's middle-aged or above. Should be an important day of remembrance for everyone. Chase flying solo with you today. I will rip through the markets, and then I got a few things I want to touch on today. Interesting day in markets and with data, so a few things to get to. First things first, S&P closed the day up about 0.85, so a nice surge on the day there. NASDAQ 100 up 0.58. IWM a big gainer at 1.85. Equal weight beat the S&P as well, up 1.5. Mag 7 was up about 1. All world ex-US was up 1.13, so beat the S&P by about 30 basis points. That was thanks in part to the dollar being down another 0.27, and you're now a little above 97.50 on the dollar index. Bitcoin is at 114.5, up a little bit today. Oil down 2%. You're a little above $62 there. Gold down a little bit, but gold miners up over 1%. Silver up over 1%. Palladium up another 1.5. As far as yields went, you were kind of flat on the front end, but down a little bit on the long end. But all yields across the curve have fallen a lot in the last, call it 2 weeks, something like that. And rightfully so, as data has labor market data has shown some significant concerns in the last couple of weeks. So that's worth noting. Tesla was up 6%. That was a big piece of Mag 7. I think if you looked at Mag 7 without Tesla, I mean, the market crushed it, which is a little bit interesting. It was a strong day for China. FXI, the large cap ETF, was up 2.5. You had Alibaba up like 7-8%. Their technology ETF, which doesn't even have BABA in it somehow, was up over 4.5. So a very strong day for Chinese equities. Alibaba ended up closing up exactly 8. A few things I want to talk about. First thing is inflation. We had the inflation print come out this morning. It was close to in line. So the way I view it is like, because it wasn't some giant blowout, like no one's worried about it. No one cares. Despite that, it was up 0.4%, up if you drill in 0.38 and change. That annualizes to 4.6%. Always dangerous to take 1 month and annualize it, but still, like that's how bad this print was. There's only been one print worse than this in the last 18 months. So very, very hot print. If you look at 3 month annualized to get away from just, being too drilled in on 1 month, because that really isn't fair. 3 month annualized is running at 3.5%. That was under 2 back in April. The 3 month annualized core CPI is running at 3.7%. So, this last, I call it since Liberation Day, since Liberation Month, however you want to look at it, since we got tariffs announced, there's been really no question that inflation has reaccelerated. Obviously, there's a very healthy debate on whether or not we should just ignore it or not, and maybe we should, but there's really no debate on whether or not tariffs are causing inflation and whether or not we are having a significant move back higher in inflation. Like, that's just a yes. Core goods, which to me is kind of roughly the best way to kind of look for the tariff impacts here. you're back above the entire like 2010 to 2020, like that whole range. You were never as high as you are again here. It's worth noting, like core goods for most of the last 20 years, like are in deflation, and now you're not just in inflation, but like well above 1% inflation, and kind of going straight up. Um, and the tough thing for people looking for this to like peter out, roughly now, there's people that were already expecting soft inflation. Um, is the services side is staying pretty sticky. I, I've been definitely open to in a scenario where you get a lot of goods price inflation from tariffs, but then short term, at least, rents and stuff are weak enough to allow the services side to come down and kind of mute the whole thing out to where it's just like almost like an even thing. Like you're just chugging along at like 2.5, 3, and despite the fact that you are getting a bunch of goods inflation, so far it's actually in a way been worse than I expected because the services side has stayed sticky. I would fully expect the services print next month to be lower than it was this month. Like rent was pretty high, which frankly doesn't really make any sense. So I would look for that to come back down, but I also look for the good side to kind of keep chugging higher. A lot of this stuff has just now been implemented, in the last 4 or 5 weeks. So the amount of stuff that still has to flow through, the amount of old inventory that has to flow through before new tariff inventory comes through, like all these things are creating, frankly, long and variable lags. Um, I read something recently that I thought was worth mentioning and kind of fits in with a lot of what I've been talking about this year when it comes to capital flows, and the performance of the rest of the world versus the U.S., whether that's in currency or in equities, whatever. This is from Brad Setzer from the Council on Foreign Relations, and he wrote about how if you look at the data, like there's this popular narrative that if you go back to the financial crisis, the dollar went up, and everyone just assumes like it's because like foreigners freaked out and they bought a bunch of dollar assets, so a bunch of like inflows pushed the dollar higher, despite the fact there was a crisis. And historically, it kind of works that way. Everyone, lunges towards the dollar for safety. And he made the point, and obviously back in April, we did not see that. People did the opposite, which was something I commented on heavily at the time because it was so noteworthy to see, U.S. stocks down, bonds down, and currency down all at the same time. I told you, like, people were taking money out. Well, Brad's work shows that if you actually go back to 08, there were actually capital outflows from foreigners. They actually did take their money out. They weren't rushing in to buy dollars. They're actually taking money out. But at the same time, Americans who had trades, investments abroad, they brought so much money back home to the U.S. that on net, like it turned into like a capital inflow. But that was more like carry trades unwinding than it was, foreigners reaching for dollars. And the way I would look at this is obviously that's what 17 years ago now somehow. A lot's changed since then, and not really for the better for the US when it comes to the positioning here. Like if you look at net international investment position, it's deteriorated significantly is not strong enough a word, like radically. It's deteriorated since 08, which means, Americans have less money invested abroad compared to how much money foreigners have invested in the US by like orders of magnitude. So if you did get another some sort of shock or crisis of some sort where you would expect like, here come the foreigners, they're going to come buy the dollars. Not only would that not be true, it might be like viciously not true, where the dollar may not rally, but may sell off significantly. You imagine like if you look at this year where Europe, China, most of the rest of Asia, Latin America, basically everyone is outperforming the U.S. And the U.S. dollar's having one of its worst years in history. If that were to be the case when people were kind of able to do that look back of like a year or two or whatever, like, if China's beating the U.S. by 30% in equities, and their currency is way, stronger than America's, like why would Chinese people like freak out and go try to buy dollars? Or why would, Koreans or Japanese or whoever, right? Why wouldn't they just take money out of the U.S. and put it in China because it's outperforming, the currency's more stable, etc. So point being, I think a lot of us have always taken for granted, like, if there's a crisis, everyone will just flood into the U.S. And I think that was true, 20 years ago, 30 years ago, whatever. But It literally wasn't true in '08, and it has all the reasons in the world to be even less true today. Something to keep in mind if if things ever get weird along the way. Um, the deficit is something I wanted to quickly mention. So they actually, put out the data every month on where the deficit is, and this past month it was a $344 billion deficit. Obviously, going back to don't annualize 1 month of data, right? That would be pretty astronomical. I mean, I think you were over 300 billion this past month as well. So you're talking over 600 billion worth of deficit in 2 months. Just pretty intense stuff. And this comes off the a lot of rhetoric of like, oh, we might balance the budget and pay down the debt, and we're going to make so much money in tariffs that we may have some extra. Like, none of that's going to happen. We're still running an enormous deficit. The only thing that happens now is if someone wants to take the tariffs away, whether that's the next president, or if the courts are like, you can't do that, and we have to pay it back and pivot to some other kinds of tariffs. The deficit would blow out to probably maybe 9%, like almost instantly, which is, I don't know, it's just interesting.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
One last thing I'll leave you with, and that is some geopolitical, well, a lot of geopolitical news in the last week, with the Israelis doing a strike in Qatari territory, which is crossing a pretty significant line, as well as very significant action in Poland, where some Russian kind of one-way attack drones entered Polish airspace and were shot down. And that was over 10 different drones. And they, not just like crashed at the border type stuff, but like actually went pretty deep. We still don't really know much about that. As far as I've seen, the Russians haven't said anything about it. Right before I started to record, President Trump said like, "Oh, that may have been an accident." It's not impossible if it was to be an accident. Would think about GPS jamming, things like that. It is possible, but I also would expect them, if they were doing kind of a probing mission, to catch, figure out what the response looks like, both tactically and politically. I would expect them to try and do it in a way that they could, have some plausible deniability. So just interesting, a couple big geopolitical things that have happened here in the last week that hadn't talked about just yet. That, I don't know, at least required a little bit of chatter. As far as looking out next week, I mean, we're absolutely going to get a Fed cut next week. Oh, that was the other thing I did want to mention. Initial jobless claims were very, very high. They were over 260,000. We've been in the 220s, 230s a lot. So to see one pop up above 260 is very concerning. I would call that a amber light. Like, it's not really yellow. This is orange. Like, it's on its way to red. So, but getting a spike in these on 1 month because one big company let go a bunch of people, or the government let go a bunch of people, like, that does happen. So I would want that to sustain for 2 or 3 months. But if it does, if you get 2 or 3 prints above 250, above 260, then all of a sudden, you have to take your recession odds and just, if they're under 50, you probably should double them. And I've always viewed 300 as going to be like that threshold. You get a 300 print, I think you're in a recession. You may be starting to tease one anyways. We had negative jobs in June. So to see this whole time from 2020 until now, we have never really seen a sustained move above 250 in jobless claims. You've had a few spikes above, but like no like sustained move. So the next week's jobless claims gets really important, and the week after. I think everyone's base case maybe should be that it goes back down, and it's okay. But and the other thing too, like I mentioned, rates going down a lot. Mortgage applications were pretty solid this week, best in I think 3 years. So obviously, I've been super concerned about construction jobs, and that finally did roll over. You're negative 4 months in a row. That takes my recession odds higher. But I would expect housing to at least start to recover a little bit here. It better. The problem at the same time is unsold inventories of new homes is so high that even if you do start picking up a little bit and you get a little more activity, like if I'm a builder, I'm still not like really chomping at the bit to get out and start do a bunch of new starts when I already have a bunch of inventory. So I think what you need is like 3 really good months of demand, home sales, get that inventory, kind of flying back down, and then builders can get back out there and start doing more. It's going to cost them more because of input costs from tariffs and stuff. But if they see demand like really pick up and rates are down, it could go a long way to stabilizing the broader economy to get housing just kind of back on its feet there. Problem, of course, would be prices could follow back along and move higher, which in some ways is self-defeating. And that's one of my things when it comes to these inflation prints. I think everyone just wants to view it through like, should the Fed cut or not? And obviously that's important, but maybe more important is the political aspect, like how unpopular policy and policymakers get based on inflation rates. And maybe the Fed can look through transitory inflation pop for a year or two on tariffs, but can GOP congressmen and congresswomen, senators, the president, his team, can they like see it through without having to deal with political problems, is maybe just as important as a question. But at the end of the day, you start getting job reports like we've had and jobless claims like we just had, and I mean, it would probably be weird not to cut rates on that. So with that said, I personally don't expect a 50 basis point cut. I think it'll be 25, but I don't think it would be shocking to do 50, but I think it would be a stretch. But maybe a series of 25s, as long as the labor market looks as questionable as it does now. And they've kind of made it clear, even Powell, like they're going to look through the inflation side. So yeah, we're up 0.4 today, but if you're going to look through it, you're going to look through it. And to Waller's credit, I very vehemently disagree with his view of how quickly transitory this will be. But even he's said, oh well, and I have scenarios where it goes into the 4s, and like we should look through it. So here we are at 3-ish, and so if he's willing to look through 4, I'm sure he's willing to look through 3. But we'll see how it goes. But I fully expect to cut next week. I also fully expect it to not really help the economy much. And if we are going into a recession, which is not impossible right now at all, then equities are on, just they're taking crazy pills. Like they would need to go way back down. Currently, equities are pricing getting cuts while also not having a growth problem. So if we do have a real growth problem, if unemployment accelerates from here, then equities are going to have to turn back around and look lower. You're going to have to get crazy revisions lower on earnings and everything. But if not, and you get cuts and you get to have keep the growth, just almost like another soft landing within a giant soft landing, then equities keep doing what they're doing. But even there, I think it's important to remember, like, the U.S. stock market's having a pretty decent year, but if you price out almost any other stock market globally in dollar terms, it's beating the U.S. and probably by a lot. So it's easy to forget that there are other alternatives out there, and most of them are actually outperforming. Even on a day like today, non-U.S. stocks beat the U.S. despite a really solid day. But that's it for me. We'll be back with a Friday show tomorrow because somehow it's already the end of the week tomorrow. And yeah, we'll wrap up the week tomorrow. Don't forget, you can download, subscribe, knowyourriskpodcast.com, and check us out on YouTube and all the other social.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.